always find it better to be able to go back and to be able to recap on things. So let's start. Financial success through property investing. A bit of housekeeping. As we all know, technology is sometimes a bit challenging. Let's see whether we can get it right and whether we can get through this without a hiccup this time. But please be patient if we have some issues. I've already alluded to it. If we can leave the cameras and the questions to later on in the Q&A session, I'd love to see you there, and I'd love to hear your questions. So feel free to put your camera on later on. The microphone on mute again until the Q&A session. There is no such thing as a silly question as far as I'm concerned. The only silly question is the one that is not being asked. So please, whatever questions you have, I will stay here till 11 o'clock. Just kidding. And answer every question that you've got. So feel free. There is no such thing as a silly question. And we will email the recording to you. Thank you for joining in. Your interest is much appreciated. We are all busy people, and I'll do my darndest to provide you with great content. So this is the They Make Me Do It. The information provided in this presentation is general in nature. Obviously, we all have different circumstances, so please discuss with your own advisors to curtail and to make these investments suitable to your own personal circumstances. During the presentation and afterwards, I will also offer you to take up the option of a one-to-one discussion with myself, where we can go into the personal circumstances. So feel free to take me up on that. Everything that I talk about is gained from over 20 years of experience. And one thing you can rest assured about, and that is we will only propose what we're prepared to do ourselves. So that is important to us. We've built our business on that basis. This is our reputation. It is only what we are prepared to do ourselves is what we suggest to you. I find it pretty silly to do anything else. We say what we do, and we do what we say. Okay, let's get into it. So what do we want to cover today? I'm going to keep it fairly simple, so I can see we have got a very much a mix of investors in the experience level online. So bear with me for the ones that have a good amount of knowledge and for whom this is a bit basic. Feel free to cover off more and cover off more complex things in the Q&A session. But we got to cover the basis off first. So I'm going to start off with the how, the what, the with whom, what next, and the why. Very, very simple. And yet, it is simple but not easy. So, the how. The first thing, and forgive me, with my heritage, you may have already figured out, English is not my first language, it's not my mother tongue. Came to Australia some 33 years ago. I can be a bit direct, I don't mean to be stepping on anybody's feet, but I take property investment as a serious business. And that is what I would suggest to you. And anything that I do is suggest only. So this is a smorgasbord, you take what you want and you leave what you don't want. But my suggestion is treat it as a business. And as a business, we want to be unemotional. We want to be looking after things from a business point of view and not from a hobby. Now, from a hobby, hobbies cost money. Hobbies are entertaining. Believe you me, property investment can be very entertaining, can be very much fun, and is fun. It is fun. But we should be looking at it from a business point of view. We should be doing unemotional, off-site and on-site research, and be, Lenny, would you admit, Paul? And be unemotional about it. There is a famous saying of, I think it was, who was it? One of the greats, I forget at the moment the name, Warren Buffett, that's who it was. He said, if you cannot control your emotion, you cannot control your money. So that's something that I've very much taken to heart, and I suggest that to you. Let's be unemotional for that property investment side of things. Property investment ought to be a system, because only with a system we can maintain a result that is predictable and duplicatable. I don't believe in the lucky draw. Yes, luck helps, but if we can follow a system that is geared to success, that is predictable and duplicatable, we can do it many times over. And that is the trick to property investment. Predictability and risk mitigated outcome. Again, if we have a system, if we follow a set of rules, if we do our research, if we do our due diligence, look for possibilities that may or may not occur, and think about ways to mitigate risk, that can only be a good thing. Now, what do we want to do? In our world, it is all about a balance between yield and growth, between income and capital gains. I'll cover more on that. We suggest that you have a 10-year property investment strategy. Ladies and gentlemen, let me say it right off the bat, there is no get-rich-quick scheme. Property investment is no get-rich-quick. Yes, you can make a lot of money in a short amount of time, but that is luck. That is not property investment. So my suggestion is you got to give it a 5 to 10 year property strategy, a window of opportunity. And again, now it depends what you want to achieve, and we will only be able to help you to what you want to achieve. Whether you are after financial independence, whether you want to have choices in retirement, or some people want to leave a legacy. The whole investment strategy is dependent upon what you want to achieve. Now, we all start with one property, but quite frankly and quite openly, one will not achieve one of those three things. So ultimately and preferably, our system, we as property friends, are geared to a 3+ property strategy. I would love to work with you for the long term. And we've got a number of people here on the call. And thank you, Vivek. Yes, the pictures from Hobart are lovely. And Vijay as well, yes. The property that you're seeing on the screen, that's one of the properties that we did in Hobart. About 3 years ago, we started. Anyway, I digress. So 3 properties or more will set you free and will get you to whatever you want to achieve. Now, risk versus reward, I'm a scaredy cat. It may not look like it, and that is by intent, but we always cover the downside. Return off our money is more important than return on the money, because once you make a loss, it is so much harder to recover from that. What is the right deal for you? That is the $99 question. And for that, we will offer you later on a strategy session that is one-to-one, free of charge, so you can take advantage to that. Because that is a very personal discussion. We want to find out what is your specific goal. So, yeah. Now, there is a lot of talk of what is the right strategy. So, there is essentially two big drivers that drive property investment. One is rental yield. So that's your rental return, that's your income. And that's, I call this the short-term money. This is our cash flow monies that come in every week or every month that pay for the mortgage and the expenses. Definitely something that we need to have an eye out for. And in my world, in our strategy, it is something where the rental yield needs to be high enough for all of the expenses, that is mortgage, rates, and everything else, to be covered by the rental income. I'm not a big fan of big capital losses. Yes, you get a tax benefit, but you can structure it that you can take advantage of the tax write-offs, yet still have positive cash flow. And that is a much nicer game to play. So the lifestyle and the cash flow with high rental yield is what you achieve through that. Financing is a lot easier because the property pays for itself or more than pays for itself. And that means that the banks are happy to lend to you. Nothing is more prevalent than the people that have big negative gears and then get stuck with the first property because they've got $500 or $1,000 loss every month that they need to come up with from their after-tax cash flow. It is the small money. I agree with that. It is the $50, $100 to $500 per month that is coming in. But it is the money that keeps us afloat. So very, very important in our view to have enough rental income for the entire cost of the property to be paid for. Now, the flip side of the coin is capital growth. Now, capital growth is the long-term money. It's the monies that we need to wait for the property price to increase. Now, how long will that take? It's a question. If I had $1 for every time that I got asked that question. How long will it take to make property increases in value? Well, that just depends. The 10-year average, and it seems to come through over the 100 years average, is about 6 to 7%. Now, of course, it is beautiful if we can time the market and make that work, that just when the market goes up, because in the 7 to 10 year cycle, there is about 3 to 4 years where nothing happens, usually 3 to 4 years where the property goes up, and 3 to 4 years where it just sits there. Now, naturally, it is beautiful if we can time the market to just enter the market when the rise happens. I tell you what, that is a hard science to break through. I've been trying for 20 years. We're getting better at it. We're actually pretty good at it. But timing the market is not as important as time in the market. I love this little sayings. Again, 5 to 10 year period, I suggest to you 10-year period is the minimum that you need to be able to really stay in property investment, stay with the property. So the long-term money is the capital gains. It is also the lifestyle money where you ultimately can retire the debt. We do generally interest only, and the capital increases then pay back the debt. And through that, we gain the asset value. Refinancing is done on the basis of capital gains, whilst the rental income provides us for our monthly cash flow. The increase in value provides us for the refinancing options and the possibility to withdraw money and put that towards the next investment. The capital gain is the big money. Case in point, let's say that we've got a $500,000 property at 10%. Let's make my math easy. Increase, that's $50,000. Even if you get $200 a month in rental yield positive cash flow, it will take you a long time to catch up with a big capital gain. So capital gain is the big amount. Now, why do we say we want both? Because I'm a greedy bugger. No. It's got to do with risk mitigation, and it's got to do with cash flow. So what we want to do is we want to have an area, we want to find properties that have enough income to fully pay for themselves and then have capital gain. Now, there is typically a seesaw effect between capital gain and rental income. Wherever you put too much emphasis on one, the other one suffers. That's why we're looking for balance. So we want to have properties that have enough income to pay for themselves, but still have capital gains. That means that you can cash flow the property without having to, what I call, feed the dragon, meaning pay out from your after-tax income and fund the property. But on the same time, you can just sit there and wait for the capital gain because it has no influence on your lifestyle or cash flow. And we've got a number of people on the call today that have done exactly that. This is the strategic nature of the investment. And for the avoidance of doubt, strategy has to be the top, well, actually the second most important matter when property investing. So that's the reason for capital growth and rental yield together. I've promised a case study, which is this property that we're looking at here at the on the screen. Isn't that a gorgeous view? And this is what I call a position advantage. This is in Tasmania, purchased in 2018. House and land was purchased for $360,000. The anticipated rent was $390 per week. Paul, I've turned your video off. Forgive me, the bandwidth is going down a bit, so I hope you don't mind if we can switch it on. Happy to switch it on during the Q&A session again. So the rental yield anticipated was 5.6%. At 5.6%, this property would certainly cash flow itself and pay you even a little bit of money. However, it got better. Today, the value of this property is actually close to 600. I'm always very conservative. I find it's better to underquote and everybody's happy if the figures come in higher than to overquote and do the marketeering stuff. And then people are sad when it doesn't happen and they're cheesed off. I don't believe in that. So the value today is probably 575, 600. Actual rent is 530 and a rental yield of 7.1%. That, ladies and gentlemen, is not at all a bad deal. That is a magnificent deal. And this is the trick. You want to buy a property where you have inbuilt capital gains so that you have, one, a security buffer, and two, you can jump into the next property by withdrawing equity fairly swiftly. That's the system. Now, I promised to divulge a hotspot. We are driven by figures. So, in the first place, we go by the statistics and we compare a number off, because quite frankly, I don't believe any statistic unless I'm fiddled with it myself. There are so many different opposing points of view in the market that you need to compare various statistics and then go to site afterwards. But let's have a look at the stats. So vacancy rate of 0.4%. Between 3 and 4 is generally considered to be a balanced market. at 0.4, certainly tight as a drum. The asking price at this location, which by the way is Cairns, 492,000. In the last quarter, it went back up by 10.6%. Now, again, careful with statistics. This is the asking price, not the sales price. However, the asking price is a precursor to the sales. So by the asking price going up, the sales price goes up for sure as well. Stock on the market is 73 days, which is a 10-year low for this location. The weekly rent is $501 per week. Again, I go 1 in 100, which is 5.2%, so great rental return. And this rental yield went up by 11.3 in the last quarter and is continuing to go up. At 0.4%, tenants are multiplying in their applications for properties. That competition is great for the rental return. The infrastructure is something that you want to look at. Is the place growing, both in infrastructure, in population? In this instance, we have a new shopping center being built, the highway is being extended, and a big retirement village is being built. The government has just last week allocated an $80 million Navy project to Cairns. So that is certainly a great investment into the area and certainly pointers for a market that is going to improve and that is going to be very competitive. We want to have growth because growth is driving the market and is the big money. Now, after all this statistical information and after all this offsite research, there's one thing where a lot of investors, in my way of thinking, fall down. They just do the offsite research, or believe a buyer's agent, a marketeer, on their research. You need to have the eyeballs on the place. You need to be on site. You need to feel the place. You need to touch the place. You need to be in contact with locals and do on-site verification of what the off-site figures say. In my view, it's a must. It's non-negotiable. Now, of course, you can employ somebody to do that, or you can do it yourself. We have some people that come up to site and check out the sites themselves. I invite people to do that. Very few do, which is a compliment to us and which shows that our research and track record is excellent. But it is something that needs to be checked either by yourself or by your people that you employ. Now, personally, I'm also a believer in get specialists to do what they do best, and that is to look after their specialist areas. And we all have areas of expertise that we can look after. So, yeah. Now, with whom? Allow me to indulge myself a bit. Property Friends has been in business for 20 years. 76% of our business is from return clients. So something is working here. And we do that specifically with specific intent. We are very much in favor of long-term relationships. Our 7-step success system provides accurate, unbiased investment guidance, training opportunity, and mitigates risk. Again, return off of money is much more important than return on the money. Yes, we are investing for return on the money, but we got to cover the downside. Full disclosure, You can look into anything that we have available. We share every research with you. We get paid by yourself, separate to the deal. Now, this is really, really important in my view. And that is because ultimately we serve who pays us. Now, isn't it a conflict of interest if a buyer's agent, if a consultant of yours gets paid by the developers or by the builders? I reckon that is wrong. So, and I want to be able to look at every one of us in the eye and say, you pay what I would pay. No funny business. We don't take any brown paper envelopes. There is no hidden commissions. And anything that we do, any referrals that we give are ex gratia. We don't charge anything for it. We want to keep the team together because in a team, we have strength, we have leverage. So I think that's a great point. And do your comparisons. Ask any advisors, what's in it for you? How much do you get? And the typical answer will be, you don't need to pay for us. Our services are paid for by the developers or the builders. Well, I have a challenge with it, I have to admit. And typically the fees are $30,000, $40,000, $50,000 per property. And I think that's just overboard, going overboard. Check out our client feedback and testimonials, and allow me to play you a testimonial.
My ambition with this my first entry to property investment was to alleviate the difficulties I'd had previously with trying to accumulate some wealth. Superannuation had crashed and banks were useless. So I thought, and after talking to Uwe and Property Friends and their mission, I thought this has got to be the way for me to go, and to get a decent return on my hard-earned cash over the last 40 years I've earned. So I hope to gain out of this. I hope to get a good capital growth. I hope to be able to use the capital growth to go into more investing and hopefully stop working in the rat race within the next 10 years. The most important outcome of this project has been that I now don't have a fear of investing. I was very fearful of throwing my money into something and I wasn't quite sure, but Property Friends has taken that fear away for me. Once I get this settled and it looks like it's doing whatever I expect it to do, I'll be talking to Uwe and Ulla again, and we'll see what we can do again. I've had a couple of friends ask me what I'm doing with my life, and I've of course been pretty proud to tell them that I've got an investment property happening, and they've asked, should they, why would I talk to someone else? Why didn't I do it myself? So I've said to them that that if they're thinking of investing, all they have to do is give Uwe a ring. He will tell them all they need to be told over the phone. If they meet with him, they'll understand what sort of people that they might be dealing with, and that gave me, and I would be sure gives them a warm and fuzzy feeling, and would give them the confidence to let Uwe and Ulla and Property Friends handle any investment property for them.
Yeah, look, I'm very grateful for these testimonials, and if you want to check out a couple of them, we have got plenty of testimonials on the website. You will understand that most people are a bit hesitant to talk about their finances and their investments. So that's why I'm even more grateful to have very satisfied clients that have been willing and able and happy to give us feedback. So just hop on the website. There's plenty of written and video testimonials. Okay, now here comes the biggest point, the why. Why would you do it in the first place? And this is one of the things that we need to be very clear about. What is in it for you? What would you like to achieve? Are you after financial independence? Are you after choices and retirements? Are you after leaving a legacy? that, to be honest, is one of the things that drives me. I want to leave something for our kids and want to also have choices in my retirement. Financial independence is pretty much there for us. So what drives you? And this is why it's so important to have a one-on-one discussion. Because one of the things that I want to find out is, where are you at? Where are you at? And where do you want to go? From there, we can devise a strategy, get the information, and do the due diligence. But really, doesn't it make sense? I can just about hear some of the guys on the call laughing when I say, where are you at? It's a question that I open just about every relationship with. Doesn't it make sense? We need to first find out where we are at. If I'm in Melbourne and I want to go to Sydney, I can devise a plan to get there. But if I don't know what my starting point is, I'm lost. And a lot of people are lost out there. And with property investment usually being one of the biggest investments that we do in our life, it oughtn't to be left to chance. So, yeah, leave it to the system. What's the end goal? Where do we want to go? And then only can we develop a customized multi-property strategy, which is set up during the discovery call and which is set up as a long-term strategy during the discussions. And we will lead you through the process. We have many, many property investors that have been with us for over 10 years that have more than 10 properties. That didn't happen overnight. No, I'm not going to make a fuss about it. It will take time, but it's entirely possible, and will guide you through the process. So I've kept it fairly short and succinct. I'd love to open the question and answers now. So feel free to unmute yourself and feel free to ask any questions that you have. I'm happy to answer any questions. Lenny, did we have any questions during the presentation?
Yes. Hi, Uwe. Yes, we have questions. Number one, is it always good to invest in the current property?
Is it always
good to invest in the current hotspot?
Okay. Yeah, look, hotspots are a two-sided coin, a two-edged sword, I think is the more appropriate description. I love areas where the fundamentals are fantastic. If I can find an area where the fundamentals are fantastic and where the market is just on the rise, that of course is the best of all worlds. That's the nirvana, that's the heavens. But the underlying fundamentals are more important, because if the underlying fundamentals are right, then I can just let the property do its thing and wait for the capital growth. But if the underlying fundamentals are not right, and if I buy at close to the top, then I've got to wait for a while to get the capital gains. Now, the waiting for a while to get the capital gains is not an issue if it doesn't eat me out of house and home. If I don't have to have a $500 or $1,000 a month after tax input into the property. That's why it is nice to find the rising market, to find a hotspot, and we're doing well with it. With 20 years of experience, we've identified the pointers that indicate a rising market, but listen, hear me loud and clear, nobody can guarantee it. There are pointers and they make it very predictable and likely, but nobody can guarantee it. I mean, just look at ourselves 2 years ago. Who would have thought that a pandemic influences the entire world as it has? Now, I'm happy to report that during the pandemic, our properties were okay. And that is, again, risk mitigation. So, yes. It's nice if you can get it on the upward swing, but the fundamentals are more important. Great question, Lenny. Do we have any other questions? Or if you want to open your microphone, be my guest and ask any questions. Do we have any other questions, Lenny, that came through?
Yes, there's another question. You seem to be preferring large country towns. If yes, why?
The answer is yes. I was talking about the cycle in the market. It's no secret that most capital cities have overshot the market. Melbourne's prices went down 1.3% last month. Sydney's were over 1% minus as well. Brisbane will not be far behind. Perth is still growing, but the biggest issue with the big city markets is typically rental yield. If you only get a 3.5% to 4% rental income, that will not pay for the total expenses of the property, which means that you need to put money into the property every month. And that is what I don't want anybody to do, because that means in turn that you cannot live your life as you've lived it before. The dinners out get less. The holidays get less because we need to fund that property from somewhere. And this is where your subconscious, after a number of years, take the example of Sydney. 7 years, no capital growth. Can you imagine what happens? You're paying for 7 years, $500 per month of your after-tax income into a property. That ain't much fun. And that will certainly have an effect on your lifestyle. And the banks will make it difficult. And who can buy 2, 3, or 4 of those? That's why this doesn't work. Now, the capital cities have typically lower rental incomes. The larger country towns have typically higher rental income. And that's why we prefer them. Again, we're coming back to the balance between growth and yield. Great question again. Hey, this is good. This is fun. You're putting me to the test. Any other question?
Yes, we have another one. Thank you for that answer. So why do you emphasize so much on balanced rent and growth? Why not convert growth into income?
You can convert capital growth into income. Yes, you can run a rising debt strategy. But the biggest challenge that I see is if you rely on a capital growth strategy. So let's take Melbourne, for example. Albert Park. I buy a small two-bedder for $1.5 million, and I've got 2.5%, 3% rental yield. Now that means that I need to put $1,000 a month into the property. Now, that's definitely an ouch. That hurts in my books. But the big thing is, what happens if it takes 3-4 years for capital gains to come? In these 3-4 years, you've got to curtail your lifestyle. I've covered it before to a degree. But the biggest thing is you're stuck. Because you have a high negative gear, You can't do anything else. No lender will give you additional funds to continue on your journey. There are 3 phases in property investment. The accumulation phase, where the one that collects as many properties as you can, according to your system, according to your plan, wins. The consolidation phase, where we let the properties sit and rise, have the value rise, look after the retiring of the debt. And then the repatriation phase, where you take the money out and or sell down to whatever you're comfortable with. Now, the first phase, the accumulation phase, can only be done when you've got enough rental income, because otherwise your serviceability is insufficient. The banks won't let you any money. Now, at the moment, it's reasonably okay because we've got such low interest rates, but these will go up, and that will make it even more difficult when you've got a high negative gear. Hence the strong suggestion for balance. Really good questions tonight. Excellent. It's 7:45 already. I may take 1 or 2 more. Anybody wants to ask any questions? Or do we have any more, Lenny?
We have one last question.
Okay.
Do you think is the most important and why?
I think the line is breaking up a bit. Can you please repeat that?
Why 3+ property strategy? What do you think is the most important and why?
Okay. So the reason for very much from the outset going for 3 properties or more is, yes, it's nice to have one investment property, and that's entirely possible, and that's everywhere everybody starts. But that's not going to change our life dramatically. You need 3 or more, and that is, when you set it up from the beginning as a strategy, so much easier. Now, 3+ properties will change your life. No questions. We've proven that many, many times. And again, I invite you to go to the testimonials. There are plenty of people in there that by video, by words, confirm that. So why is it important to look at a multi-property strategy? Well, if you only want to start with one, and that's where we all start, that's great. But I'll do my darndest to prove to you that this is a very simple process. Not easy, but simple process that is repeatable and duplicatable. Now, if it works, and it will, then we can do it again. And here we again close the loop. This is the reason for the high yielding strategy, for the high rental income. You can only keep going if your rental income is high enough so that you don't get shut off by the banks. So that is really the reason for the balance strategy. Okay, I might take 1 or 2 more. We've got some experienced guys on the call. I can see Robert, I can see Vijay. I can see Paul, Casey. Yeah, feel free to ask a question.
We have one question from VJ.
Yeah.
So how many properties do you need over 10-year period where you have a livable cash flow if you retire in 10 years with cash flow?
Great question. I'm not meaning to be funny, Vijay, but the answer is, how long is a piece of string? That very much depends on what cash flow do you want to set up for. Some people tell me $70,000 a year. When I go into my retirement, I've got my house paid off, I've got a new vehicle or 2 new vehicles. I've got all the toys that I want. I really only need to tick over. $70,000 income after tax is great for me. I've got people that tell me, you mean what? 70,000? I couldn't live off that in the world. So that's the one-on-one discussion. That's where we find out where are you at and where do you want to take this. And there is no right or wrong. There is only what do we want to achieve. Then we look at where are we at. We devise a strategy. And then there is a fourth point that virtually nobody does. And I like to put it on like the cherry on the ice cream. As a fourth point, we check, can we do what we say we want to do in the time frames that we've allocated? Because if the result is you need to work 25 hours a day, that makes it a tad difficult. So it's good to check the result of the strategy discussions against, is it feasible? And are we really able and willing to commit to that? I've got some young guys that bought at extremely high LVRs, loan to value ratios, a big number of properties. 5 properties in 6 years. Now, they are gung-ho, they went hell for leather. And they're looking good, by the way. But that's not for everybody. As you can see, I'm not 21 anymore. I'm more risk averse. So that goes back to the strategy. Does that cover that, Vijay? You gonna?
Thanks, Uwe. I'll book a session with you.
Sounds great. Sounds great. Love to have a chat. Love to have a chat. Anybody else? I'll take one more question. It's already 10:02. Or have I covered everything off? As a special offer, I have written a book which only took 4 years to write. It's normally $15. If you want to get one, you can go to our website, and with the discount code ebook for success, you can get it for $10, the PDF version. We'll email it to you. Other than that, this is the link. Lenny, maybe you can put it into the chat box. Oh yeah, she's done it already. Magnificent. See, this is what I love. I love working with great people. This is why I'm having so much fun with our team of investors. When we're all wanting to achieve the same thing, it's so much fun. So you can feel free to copy that link. Feel free to book in for a session. Thanks very much. It's been an utmost pleasure of mine. I hope it gave you some pointers of what to look out for. And I'll see you on the beaches of the world. Have fun. Enjoy. Bye-bye. If you've got any other questions that you may not have been able to ask, or if things come up later, feel free to send us an email. Or even better, book the discoveries. Bye-bye. Have a good one.